Which of the following best describes a key advantage of operating as a sole trader in the financial services industry? A. Access to unlimited capital from shareholders. B. Full control and decision-making authority. C. Limited liability for business debts. D. Mandatory financial reporting to a SIC. The correct answer is B. Full control and decision-making authority. Explanation. A sole trader is the simplest business structure where the individual has full ownership and control of the business. This structure allows for quick decision-making, minimal regulatory requirements, and direct access to all profits. However, the downside is unlimited personal liability, meaning the owner is personally responsible for all debts. In a partnership, which of the following is not a typical legal or tax implication? A. Income is split between partners and taxed at their individual rates. B. The partnership itself pays tax at a corporate rate. C. Partners are jointly and severally liable for business debts. D. A partnership agreement is used to define roles and responsibilities. The correct answer is B. The partnership itself pays tax at a corporate rate. Explanation. A partnership is not a separate taxable entity. Instead, each partner includes their share of profit or loss in their personal tax return. The partnership does not pay income tax itself, though it must lodge a partnership return. Additionally, partners are jointly and severally liable, and a partnership agreement helps define roles and protect against disputes. The primary purpose of a business's finance function is to A. Hire and train employees. B. Develop marketing campaigns. C. Manage cash flow investments and budgeting. D. Maintain its systems and infrastructure. The correct answer is C. Manage cash flow investments and budgeting. Explanation. The finance function in a business is responsible for monitoring financial performance, managing budgets, ensuring liquidity, and making investment decisions. It supports strategic planning by providing accurate financial data and forecasts to drive profitable decision-making. Without effective financial management, the business may face operational disruptions or insolvency. A SMART objective for a financial services business might include which of the following? A. Improve client satisfaction over time. B. Become the best in the market someday. C. Increase quarterly revenue by 10% by Q. D. Make our service more efficient in the future. The correct answer is C. Increase quarterly revenue by 10% by Q. Explanation. SMART objectives are specific, measurable, achievable, relevant, and time-bound. The objective, increase quarterly revenue by 10% by Q, meets all SMART criteria. It defines exactly what will be achieved by how much, when, and is relevant to financial performance. Vague goals like become the best lack measurable benchmarks and timelines. What is a significant disadvantage of using a trust structure in a financial services business? A. All income is taxed at the corporate rate. B. Losses cannot be distributed to beneficiaries. C. Trusts have unrestricted liability. D. Trusts must issue shares to raise capital. The correct answer is B. Losses cannot be distributed to beneficiaries. Explanation. One of the limitations of a trust is that losses are trapped within the trust and cannot be passed on to beneficiaries to offset against their other income. This makes it less flexible in early stage businesses or those with volatile earnings. However, trusts can provide asset protection, tax planning, flexibility, and are commonly used in family financial planning. Which of the following is an example of a technological influence affecting the financial services industry? A. Introduction of stricter consumer protection laws. B. Shifts in interest rates by the central bank. C. Implementation of mobile banking applications. D. Changes in income tax rates for small businesses. Which of the following is an example of a technological influence affecting the financial services industry? A. Introduction of stricter consumer protection laws. B. Shifts in interest rates by the central bank. C. Implementation of mobile banking applications. D. Changes in income tax rates for small businesses. Which government agency is primarily responsible for overseeing financial markets and enforcing financial legislation in New Zealand? A. Financial Markets Authority, FMA. B. Inland Revenue Department, ERD. C. Department of Internal Affairs. D. Reserve Bank of New Zealand. The correct answer is A. Financial Markets Authority, FMA. Explanation. The Financial Markets Authority, FMA, is New Zealand's main regulatory body for financial services. It enforces legislation, ensures fair, efficient, and transparent financial markets, and oversees licensing, disclosure, and conduct in investment and financial advisory services. A significant increase in unemployment in the economy would most likely affect financial service businesses by A. Reducing interest rates on loans, B. Increasing demand for luxury investment products, C. Decreasing demand for loans and insurance policies, D. Increasing the price of imported technology. The correct answer is C. Decreasing demand for loans and insurance policies. Explanation: high unemployment leads to reduced disposable income, making consumers less likely to seek financial products like loans, insurance, or investment services. Financial institutions may also experience higher default risk and a decline in revenue from service fees or commissions. Organizational culture refers to A. The organizational chart and reporting lines, B. The external image of the business, C. The financial strategies set by the EOD, the shared values, beliefs, and norms within a business. The correct answer is D. The shared values, beliefs, and norms within a business. Explanation: organizational culture defines the attitudes, behaviors, and shared values that influence how employees interact and how decisions are made. A strong culture promotes alignment with the company's mission and affects employee engagement, ethical conduct, and customer service quality, especially important in financial services where trust is vital. Which of the following best describes the role of management within a financial services business? A. Setting macroeconomic policy for the economy. B. Providing legal judgments on tax compliance. C. Implementing strategies, supervising staff, and achieving objectives. D. Regulating external business competition. The correct answer is C. Implementing strategies, supervising staff, and achieving objectives. Explanation: managers play a central role in translating strategic goals into operational outcomes. They are responsible for supervising employees, managing resources, and ensuring the business complies with internal policies and external regulations. Their effectiveness directly impacts performance, compliance, and customer satisfaction. Which of the following is a common indicator of a business's financial health? A. The average age of employees. B. Net profit margin. C. Location of the head office. D. Number of product lines. Net profit margin. Explanation: net profit margin is a profitability ratio that shows how efficiently a business converts revenue into profit. It is calculated as net profit revenue x 100 and reflects the company's ability to manage costs and maximize returns, making it a key indicator of financial performance. In a SWOT analysis, the T stands for A. Target market. B. Tools and tactics. C. Threats. D. Turnover. The correct answer is C. Threat. Explanation: SWOT analysis identifies a business's strengths, weaknesses, opportunities, and threats. Threats are external factors that could negatively impact the business, such as market competition, regulation changes, or economic downturns. Recognizing threats helps with strategic planning and risk mitigation. Which of the following best describes the difference between assets and liabilities? A. Assets are resources the company owns. The liabilities are obligations it owes. B. Assets are what the company owes. The liabilities are what it owns. C. Assets are company expenses. The liabilities are losses. D. Assets and liabilities are both classified as company income. The correct answer is A. Assets are resources the company owns. Liabilities are obligations it owes. Explanation: assets include things like cash, property, and equipment. Resources the business controls or owns. Liabilities are debts or obligations like loans and accounts payable. The balance sheet uses the formula assets equals liabilities plus equity, forming the basis for financial analysis. One of the key purposes of a business plan is to A. Report payroll figures to government regulators. B. Predict changes in foreign exchange rates. C. Guide decision-making and attract investors or lenders. D. Replace financial statements and audit reports. The correct answer is C. Guide decision-making and attract investors or lenders. Explanation: a business plan outlines a business's objectives, market analysis, financial projections, and strategy. It helps clarify goals internally and is also used to secure funding or partnerships, making it an essential strategic tool in financial services and entrepreneurship. Which of the following is an example of a reputational risk for a financial services firm? A. A sudden increase in interest rates. B. A client data breach leading to public criticism. C. A supplier increasing their prices. D. Equipment failure in the office. A client data breach leading to public criticism explanation. Reputational risk arises when a business's public image is damaged, often due to unethical behavior, regulatory violations, or data breaches. In financial services, trust is critical, so loss of client data can seriously harm client confidence and the firm's standing. If a company's cash inflow is consistently lower than its cash outflow, the business will most likely face A. Need to upgrade its marketing plan, B. Difficulty in understanding its liabilities, C. Cash flow problems and possible liquidity issues, D. Reduction in its number of stakeholders. The correct answer is C. Cash flow problems and possible liquidity issues explanation. When cash inflows, money coming in, are lower than cash outflows, money going out, over time it results in a negative cash flow. This can cause liquidity problems, making it hard for the business to pay suppliers, repay debts, or operate effectively, even if it's profitable on paper. What is the main purpose of risk mitigation in business? A. To transfer risks to senior managers. B. To ignore risks until they become emergencies. C. To increase liability and improve tax deductions. D. To identify, evaluate, and reduce risks before they impact operations. The correct answer is D. To identify, evaluate, and reduce risks before they impact operations. Explanation. Risk mitigation involves proactively identifying potential risks, assessing their likelihood and impact, and then implementing strategies to reduce or manage them. Effective mitigation protects a business's operations, finances, and reputation. In a context of risk management, insurance plays the role of A. Preventing all types of risk from occurring. B. Transferring the financial impact of certain risks to another party. C. Increasing compliance burdens on management. D. Eliminating the need for any internal controls. The correct answer is B. Transferring the financial impact of certain risks to another party. Explanation. Insurance allows businesses to transfer the financial burden of specific risks, e.g., fire, theft, liability, to an insurer in exchange for a premium. It's a key component of risk management, but must be used alongside preventive strategies and compliance measures. When communicating with clients in financial services, which of the following practices is most professional? A. Using casual language to build rapport like emojis or abbreviations. B. Avoiding documentation to reduce misunderstandings. C. Using clear, respectful, and jargon-free language tailored to the client. D. Sending voice notes instead of emails for record keeping. The correct answer is C. Using clear, respectful, and jargon-free language tailored to the client. Explanation. Professional communication in financial services means being clear, concise, respectful, and client-focused. Avoiding jargon ensures clients fully understand the product or advice. Documentation is also essential for compliance, transparency, and dispute resolution. Which of the following technologies is most commonly used by financial services professionals to manage client interactions and data? A. CAD, computer-aided design, software. BERM, customer relationship management systems. C. WordPress content management systems. D. Stock photo libraries. The correct answer is BERM, customer relationship management systems. Explanation. systems like Salesforce or Zoho help financial professionals manage client data, communications, tasks, and workflows. They improve efficiency, relationship management, and compliance, making them essential tools in the industry. Why is transparency especially important in client relationships in the financial services industry? A. It helps reduce marketing costs for the business. B. It ensures compliance with software licensing rules. C. It allows advisors to avoid professional standards. D. It builds client trust and supports ethical long-term relationships. It builds client trust and supports ethical long-term relationships. Explanation. Transparency fosters trust by helping clients clearly understand the risks, costs, and limitations of financial products. In a regulated industry where fiduciary duty is vital, this builds long-term client loyalty and reduces disputes. During which stage of a client's business lifecycle is cash flow management likely to be most critical? A. Startup. B. Expansion. C. Decline. D. Maturity. The correct answer is A. Startup. Explanation. The startup phase is typically cash-intensive with minimal incoming revenue. Businesses must carefully manage working capital and operating expenses to remain solvent. Financial advisors help navigate this through strategic budgeting and financing. Which of the following best describes A conflict of interest in financial services. A disagreement between a client and a colleague. B. Making a mistake in a financial report. C. A situation where personal gain could interfere with professional duty. D. Failing to deliver on a promised service. The correct answer is C. A situation where personal gain could interfere with professional duty. Explanation. Conflicts of interest undermine professional integrity when personal incentives. G. Bonuses, commissions, relationships interfere with objective client advice. Professionals must identify, disclose, and manage these risks to comply with ethical standards and maintain trust. Which professional is primarily responsible for providing individuals with tailored advice on insurance and investment products? A. Financial advisor. B. Underwriter. C. Accountant. D. Compliance officer. The correct answer is A. Financial advisor. Explanation. A financial advisor helps clients achieve goals such as retirement planning, insurance coverage, and investment strategies. They must adhere to regulated standards and ensure their advice suits the client's needs, risk tolerance, and stage of life. In New Zealand, which of the following is a key responsibility of licensed financial services providers? A. Follow a formal dress code set by the FMAB. Avoid reporting income for tax efficiency. C. Offer clients the lowest cost product at all times. D. Comply with the Financial Markets Conduct Act and disclose product information. The correct answer is D. Comply with the Financial Markets Conduct Act and disclose product information. Explanation. Licensed providers are obligated to follow the Financial Markets Conduct Act, which governs disclosure, conduct, product licensing, and ongoing compliance. This protects investors and maintains a fair, transparent financial services environment. Which of the following best demonstrates ethical behavior by a financial services professional? A. Promoting a product with the highest commission regardless of suitability. B. Providing advice that meets the client's needs even if it earns less commission. C. Encouraging clients to invest based on industry rumors. D. Sharing client contact details with third-party marketers. The correct answer is B. Providing advice that meets the client's needs even if it earns less commission. Explanation. Ethical behavior requires financial professionals to act in the best interests of their clients, even if it's not financially beneficial to themselves. This includes giving unbiased, honest advice that is suitable for the client's needs and circumstances. What is a key responsibility of a financial advisor when dealing with new clients? A. Provide only general financial information. B. Recommend products without considering client circumstances. C. Conduct a needs analysis and assess the client's risk profile. D. Avoid asking questions that could make the client uncomfortable. The correct answer is C. Conduct a needs analysis and assess the client's risk profile. Explanation. Financial advisors must understand the client's financial goals, needs, and risk tolerance before offering any advice. Comprehensive needs analysis is essential to ensure that recommended products or strategies are appropriate and compliant with regulatory standards. Which of the following is not typically a product offered by banks in the financial services industry? A. Term deposits. B. Mortgage lending. C. Personal insurance. D. Investment in farmland. The correct answer is D. Investment in farmland. Explanation. Banks typically offer products like savings accounts, term deposits, loans, credit, and some types of insurance. Direct investment in farmland is not a standard product offered by banks and would more commonly fall under specialized investment firms or funds. Financial services firm can best manage client expectations by A. Avoiding conversations about risks. B. Providing clear, realistic information about outcomes and fees. C. Promising high returns to attract clients. D. Minimizing ongoing communication after the sale. The correct answer is B. Providing clear, realistic information about outcomes and fees. Explanation. Managing expectations means being transparent about costs, limitations, and potential outcomes. This reduces misunderstandings and builds trust. Overpromising or avoiding discussions about risk can lead to client dissatisfaction and complaints. Which of the following is an important feature of professional verbal communication in financial services? A. Using overly technical terms to sound credible. B. Speaking rapidly to convey urgency. C. Being respectful, clear, and appropriately paced. D. Talking informally to create a relaxed atmosphere. The correct answer is C, being respectful, clear, and appropriately paced explanation. Professional verbal communication in financial services should be clear, respectful, and easy to understand. This helps ensure that clients can make informed decisions and feel confident in the advisor's professionalism. Using overly technical jargon or informal speech can cause confusion or appear unprofessional.